One small misunderstanding about credit cards make Indians lose 10,000 to 30,000 every year. No late payment message, no warning call from the banks. Just interest quietly added to the bill. In this video, I will explain credit card billing cycles in the simplest possible way so this never happens to you. If you use credit card and feel confused when you see your statement, this video is for you. By the end of this video, you will clearly understand what billing cycle is, how statement dates work, and how your spending gets divided into different bills. A credit card billing cycle is fixed period of time, usually around 30 days. All purchases you make during this period are added together. At the end of the billing cycle, the bank generates your credit card statement. This statement shows how much you owe for that month. The statement date is the day your bill is created. After the statement is generated, the bank gives you some extra time to pay. This is called payment due date. In India, the due date is usually 15 to 20 days after the statement date. Important point to remember, the statement date decides which purchases goes to which bill. Now, this is where most beginners get confused, so listen carefully. Most people assume that all purchases made in 1 month calendar are billed together. That is not how credit card works. Credit card do not follow calendar months. They follow billing cycle decided by the bank. This means February spending does not automatically mean a February bill. The statement date decides that. Let's go back to the example. Assume your billing cycle is from 5 of January to 4th February. Notice something important here. This billing cycle cuts across two calendar months. This is exactly where confusion usually starts. The statement date is for February. This date is fixed by the bank. You cannot change it every month. Now, here is the most important rule in this entire video. If you remember only one thing, remember this. Any purchases made before the statement date goes into the current bill, and any purchases made after the statement date goes into the next bill. I will say that again slowly. Anything you buy after the statement date moves to the next billing cycle. Once you understand this rule, credit card statements stop feeling confusing. And more importantly, you stop losing money without realizing it. Let's look at a realistic example. Assume that your billing cycle is from 5 of January to 4th of February. Your statement date is 4th February. Your payment due date is 24th February. Now consider two purchases. If you buy something on 3rd February, it goes into the current bill and you must pay it by 24th February. If you buy the same thing on 5th of February, it goes into the next bill and you almost get 45 days to pay. Same card, same product, same price. Only the date changed. And because the date changed, the payment pressure also changed. Top 3 mistakes. Mistake number 1, thinking the due date is the end of the billing cycle. It is not. Mistake number 2, not knowing your statement date at all. Mistake number 3, spending randomly without understanding when the bill will be generated. A credit card billing cycle decides which month your spending belongs to. The statement date locks the bill. The due date is just the deadline to pay it. If you understand and control the dates, you automatically avoid unnecessary interest. If this explanation helped you, subscribe to the channel. In the next video, I will explain the difference between statement date and due date, which confuses most beginners.